Hello, and thank you for taking the time to join us today at the AGORACOM Online Uranium Market Conference. My name is Hugh Switzer, and I'm the Manager of Corporate Development at Boswell Capital, based in Toronto, Canada. Boswell Capital is an exempt market dealer in Ontario, and through its affiliate, Boswell International, we market and sell all commercial market uranium sold by the government of Niger, located in West Africa, who today is the fourth largest producer of uranium in the world. I'm honored to be joined by four other highly regarded colleagues who work in various sectors of the uranium cycle. Today, I will be presenting a review of the global uranium markets, how the spot and long-term price is set, and how these prices affect the market in this typically illiquid and often closed global market. Today, 437 commercial nuclear power plants operate in 31 countries and provide just under 14% of global electricity demand. With the world currently constructing 68 new nuclear plants, 46 of which are being built in China, Russia, and India alone, demand is set to steadily increase over the coming years. Before I start the formal part of the presentation, I encourage all conference attendees to carefully read the following text. Boswell Capital is an exempt market dealer, as classified by National Instrument 31103 under the Ontario Securities Commission. This presentation is being made as a general analysis of the uranium industry as a whole, and in no way should be considered investment advice of any kind. I ask that you fully read and understand the text on this slide and comprehend how it applies to you. As many of you already know, the uranium market is an illiquid and, by and large, closed ecosystem of producers, end users, and commercial intermediary parties. Unlike most metals that are freely traded on multiple global exchanges, and which can usually be purchased by retail market, including physical possession, uranium is highly restricted for both physical security reasons, in addition to reasons surrounding security of supply for power generation. Uranium is tracked by 5 primary groups, who in turn publish this information to various stakeholders on either a paid subscription or client-only basis. 2 of these groups, UX Consulting, better known as UXC, and TradeTech, are the only companies that work exclusively in publishing the price without a related brokerage business. ICAP, Evolution, and Armagero all work as brokers. As a result of this, contracts in the industry are often based upon an average of the values that UXC and TradeTech report for a given period. There's one caveat to this model, however, and this relates to how prices are determined. Since there is no formal exchange under which material is traded, UXC and TradeTech rely on at least one of the parties in any given transaction to report the date, value, quantity, and oftentimes the identity of the other party in order to set their prices. Of course, this relies on the disclosure of confidential information and an expectation of implicit trust from the reporting agency. ICAP and other brokers who publish a uranium book often base their prices from actual transactions that they are brokering. Therefore, there is sometimes a divergence in UXC and TradeTech's prices who publish an inferred price versus brokers who will publish based on verified transaction data. Historically, only a month-end price was published, leaving both buyers and sellers to set the market how they saw fit. This was during a time of low volatility and high predictability because of the small number of producers and end users who are active in the market. As more producers came online and the number of end users increased, the frequency of reporting became much more important. Up until 2009, UXC published a price weekly on Mondays and TradeTech on Fridays. This would essentially set an opening bid for the week and a closing price at the end of the week. While this system was functional, it left much to be desired, as large price swings during the week often dominated the market. Daily pricing from these 2 groups began in 2011 and significantly increased transparency for smaller groups who are not constantly in a buy or sell mode. Liquidity has also increased significantly with traders, often taking large positions in the market, but this created artificial supply and demand, making the true direction of the market more difficult to comprehend when looking at absolute supply and demand requirements. Unlike many other metals, uranium is not traded on an organized exchange. Contracts are negotiated between buyers and sellers directly, and price levels are determined through voluntary reporting of transactions. There are two predominant measurements that are used across contracts. The first one is the spot price, which is generally a measure of the near-term single delivery transactions. The long-term price is often used in multi-year, multi-delivery contracts that begin years into the future. The chart above shows a time of fluctuation between 2007 and 2011 between the spot and long-term price. The black line represents the spot price, while the tan represents the long-term price. In the summer of 2007, hedge funds drove the spot price above the long-term price. This price trend had been building since January of 2005, when financial institutions began buying uranium as another commodity for trading purposes, preceded and followed by utilities buying material to ensure security of supply. Just before the ramp in late 2006, Cigar Lake flooded. All of these factors came together to create this anomaly in 2007, where for the first time the spot price eclipsed the long-term price. Perceived future demand and questions surrounding reliable supply drove a frenzy of purchasing at every level, from trader to investor to end user. Today, the market is much different than it was 2 years ago. As of March 18th, the spot price sat at $42.25. The midterm price, which is used for contracts that fall between the spot and long-term time period, sits at $46, while the long-term price sits between $56 and $57 depending on which reporting agency you use. What's important to recognize here is that the further out you go, fewer data points exist, which means that future indicators become more difficult to use for pricing. It's also particularly critical to understand that, on the whole, most people in the industry believe that uranium will cost more than $57 a pound in 10 years from now, but the pricing shown gives us an idea of what one would value uranium contract today for delivery in 10 years from now. Typically, smaller utilities often purchase their fuel requirements from what we call intermediary groups, such as Marubeni, who operates as Energy USA in the US, Itochu, a Japanese trading house, and Traxys, North America. In this example, these three groups act as both buyers and sellers of material, and in each case, also hold offtakes from producers or other long-term supply agreements. Larger utilities, on the other hand, often contract directly with producers, or sometimes with intermediary groups, such as those above, who have direct access to supply. While traders have added great liquidity to the market through increased buying and selling, they also amplify market swings, an example of which was in mid-2007, and more recently after Fukushima, which in some cases could only be characterized as a fire sale. This phenomenon was also seen in November and December of 2012, where some groups were seen as front-running utilities based on perceived demand. Thankfully for juniors, utilities require 100% performance, as failure to generate electricity is often frowned upon by the general population. As a result of this, utilities often seek contracts which start 5 to 7 years into the future. The chart above shows a sample of the requirements from a utility starting in 2007. Based on this, it's plain to see that this particular utility's requirements at the time were completely fulfilled 3 years out from the base year, with only a minimal purchasing requirement in year 4. This gives you a general idea of the typical timelines a large utility may be looking at when procuring material. Other than the typical and expected purpose of the spot versus long-term market, there are additional items to highlight when we focus in the uranium space. For the spot market, it delivers immediate requirements but carries inherent risk with price volatility. Much of this volatility is caused by the very institution that we credit, by and large, for bringing much needed liquidity to the market. It is also often used as a confidence trade, where two parties exchange a small quantity of material to ensure that future transactions move smoothly, as both teams expect. The long term, on the other hand, helps groups on both sides of the equation secure long-term deliveries of material at fixed, or at very least, controlled and significantly more predictable prices. Utilities often use this as a method to diversify their risk and to smooth out short-term issues that can sometimes affect production from mines for relatively short periods of time. So, the question remains, how does the spot price affect long-term contracts? When we look at the above chart, we can clearly see the general trend downwards, but it also becomes evident that while the spot price may affect future contracts to a certain extent, the long-term price helps smooth out temporary supply-demand issues. In the case above, which shows the spot, mid, and long-term price for 2012, we can see that the long-term price dropped about 6.5% throughout the year of 2012, while the spot dropped over 16% during the same time period. This illustrates the support that uranium has from long-term end users of uranium and strongly indicates the short-term market is quiet, which is consistent with the usage pattern of end users. This plays well into the concept that utilities, the ultimate consumer, continues to see strength in the price given their long-term requirements of fuel versus short-term holders of material who may not see the needed volatility in the market today, which is where their funds are often generated. So, should long-term contracts and offtakes be materially affected by the spot price? Only as much as it serves as a short-term price indicator, but the reality is that the end user market exists 3 to 5 years and beyond from today, so have confidence in uranium's future as a strong and growing demand commodity. With that, I'd like to thank you for joining me today and hope that you enjoy the rest of the conference.